The biggest mistake investors make isn't picking bad ETFs, it's picking the wrong ETF for their goal. A 25-year-old buying high-yield dividend ETFs is leaving massive growth on the table. A 65-year-old chasing pure growth with no income is taking unnecessary risk. Today, we're matching 6 ETFs to 6 specific investment goals, creating a framework that works for any investor at any stage. Think of investing as a spectrum. On one end, pure growth. You own assets hoping they appreciate with zero current income. On the other end, maximum income. You sacrifice growth potential for immediate cash flow. Most investors need something in between. These 6 ETFs cover the entire spectrum with precision. Starting at the pure growth end, QQQ, the Invesco Nasdaq 100 ETF. This holds the 100 largest non-financial companies on Nasdaq: Apple, Microsoft, Google, Amazon, Nvidia. These companies pay minimal or zero dividends because they reinvest profits into growth. QQQ has crushed the market over the past decade. It's volatile, tech-heavy, and perfect for investors with 20-plus years until retirement who want maximum long-term appreciation. If you're under 35 with steady income, QQQ should be your core holding. You don't need dividends yet. You need compounding growth. Moving slightly toward income, SCHD, the Schwab US Dividend Equity ETF. This doesn't chase the highest yields. It targets companies with sustainable competitive advantages that raise dividends annually. Think Home Depot, Coca-Cola, Johnson & Johnson. The current yield is modest, around 3.5%, but these companies have been increasing dividends for decades. SCHD is perfect for investors in their 40s and 50s who want growing income that will compound into retirement. You're building an income stream that inflates with you. In 20 years, your yield on cost could be 7% or 8%, even though you bought it at 3.5%. Now we're entering hybrid territory. Main Street Capital. This is technically a business development company, not a traditional ETF, but it trades like one. Main lends money to middle market companies and pays out monthly dividends around 7%. You get income plus potential appreciation as the loan portfolio grows. This is perfect for investors who want meaningful cash flow. Maybe you're semi-retired or building passive income, but you still want some growth exposure. The monthly distributions are consistent and the stock itself can appreciate. It's the middle ground many investors don't know exists. Leaning more toward income, SPYI, the S&P 500 High Income ETF. This holds the S&P 500 but sells covered calls against the positions to generate monthly income. Yields typically run 8% to 10%. The trade-off is during explosive bull markets, your upside is capped because you sold those calls. But if you're approaching retirement or already there, you don't need to capture every percentage point of upside. You need reliable monthly income that covers expenses. SPYI delivers that from the safety of the S&P 500's diversification. Even more income, QQQI, the Nasdaq 100 High Income ETF. This applies the covered call strategy to the Nasdaq 100 instead of the S&P 500. Because tech stocks are more volatile, option premiums are higher, generating yields around 9% to 11% or more. You're getting huge monthly income from the world's best tech companies. The downside is if Nvidia or Apple doubles, you're capped, but many retirees would rather have 10% monthly income from quality tech than chase every moonshot. QQQI lets you own innovation while collecting serious cash flow. At the extreme income end, MAGY, the Magnificent 7 High Income ETF. This is concentrated, just the 7 biggest tech stocks with aggressive option strategies generating yields of 10% to 12% or more. This is for investors who need maximum income and are willing to sacrifice almost all growth potential. You're not buying MAGY expecting it to double. You're buying it to convert elite tech stocks into a monthly paycheck. It's controversial, it's aggressive, but if income is your only goal, MAGY delivers the highest yield from the highest quality companies. Here's how to use this framework. Under 35, go 90% QQQ, 10% SCHD. Age 35 to 50, maybe 60% QQQ, 30% SCHD, 10% main. Age 50 to 65, 40% SCHD, 30% SPYI, 30% QQII. Over 65, 50% SPYI, 30% QQII, 20% MAGY. You're gradually shifting from pure growth to maximum income as your need for cash flow increases. 6 ETFs, every investment goal covered, from aggressive growth to maximum income. The key is matching your ETF to your actual financial need, not chasing what's trending on social media.